we've been focusing on the Dow and the fact that this is the 13th day in a row it is up. I like to focus on some of the other players, technology among them, and there was kind of mixed reads on the big tech readings we got out of Google, of Alphabet fame, of course, and Microsoft. More with Microsoft than this concern. You know, this AI, the cost to roll it out and get it going, they're high. So they kind of contained Microsoft's pickup after all of that came to light. Aaron Gibbs joins us right now, the Main Street Asset Management CIO. Aaron, I think we're seeing that AI is big. I'm not minimizing it. Obviously, Netflix has a job that's going begging for $900,000 a year for an AI type. But what do you make of that and the reality of this? That, you know, to get this ramped up, it's going to cost.
I mean, this occurs in a lot of shifts in technology advances, productivity advancements. You've got to put in the money in the research side.
Same thing with Amazon, was expanding its stores.
Exactly, doing logistics, machine learning, and infrastructure. And so certainly we can see some dips or over the earnings growth in those areas. I think regards to the stock market, though, just looking at the prices, those companies are very highly valued. So they're really, again, priced for perfection. If they don't meet or
too much so, did we get ahead of ourselves with these tech stocks?
I think with the mega cap names, yeah. I
really?
think, you know,
the mega cap being
your Microsofts and Googles,
okay.
And because they were the ones that really led the market for the first half of the year. And it's just been since really the beginning of July that we've seen a bit of a shift where people are looking for a little more value and looking, you know, farther ahead of like how are these companies going to continue to produce.
Well, how do you advise some of your folks who hang on your every word? I mean, is this real? I want in. I know there are some, you know, AI ETFs and the like. A lot of people thought just the NASDAQ 100 is fine. That'll do it. How do you play it?
So I'm actually advising that you want to look for drops. And so this is not exactly the time. They're still very expensive. I think most of the gains really have already happened. I'd look more towards small and mid-cap companies that are offshoots of those plays, because those tend to have been lower valued. They've been underperforming for the past year and a half. And that's where you could get more potential gains. Obviously higher risk, but certainly that's potentially more opportunity than what we're looking at with these mega cap names.
What about the NVIDIAs and all the rest that just happen to be the right place at the right time?
Yeah, you know, NVIDIA is one of the few chip companies that actually looks, even though it's trading at like 40 times earnings,
is that all?
Yeah, that's all, is more fairly valued just because its earnings growth has more than doubled, or expectations have more than doubled. But again, you're really late in the game when it comes to the mega caps. They've really been exposed, very expensive.
Unless you're super long term about it.
Yeah, but again, you know, you could see some of these companies, much like Amazon for many years during the dot-com era, where you could see underperformance for 3 years, even if they're achieving those earnings gains, because the valuations are so high, you're not going to get that outperformance from the market. And so I think if you're investing really for price performance, not specifically I love AI, I think these companies are very high risk when it comes to outperformance, and you're better off looking elsewhere because they've just had so much gains. We're talking, you know, 140% in 6 months. They're probably going to take a breather.
Got it. Always great catching up, Aaron. Aaron Gibbs, encyclopedia on this stuff.